all these good things. You really don't need a whole lot in your analysis of technical education. It's just really a matter of you applying yourself and studying day after day. If you have that passion, it makes it a really fun arena. It's not always fun, in terms of like when we're going through a challenging period, but it's a fun subject that you love to study. And it's one of the very few professions that allows us to do that is the scalability of it. If you find something and you can do it well and consistently, the real money is made by doing it on larger size, not necessarily longer holding times.
In this podcast, we had the great honor of speaking with Linda Raschke, a true legend in the trading industry. Linda started her trading career in 1981 and she has been a professional trader for over 45 years. Linda was also featured in the new Market Wizards book from Jack Schwager, which is probably where most of you will know her from. She has traded for several hedge funds, and from 2002 until 2015 she had her own hedge fund. And her hedge fund was ranked number 17 out of 4,500 hedge funds for best 5-year performance. In this podcast with Linda, we covered a wide variety of topics that include the importance of creating your own trading game, time-tested trading principles, specializing as a trader, passion for trading, and she gave a lot of practical tips and advice for new and aspiring traders, among many other topics. And now, enjoy the podcast. So hello, Linda, and thank you so much for taking the time today to talk to us.
Absolutely.
Moritz is also back here with us. Hello, Moritz. Thank you for tuning in.
Hello.
Hi, Moritz.
So I want to get right into it. And maybe we can just start. How would you describe your trading style and your approach these days? And how would you define your edge?
I am purely technical, and it really doesn't matter what the market is. So if it was a stock, currency, any market that is driven by supply demand variables, I try to stay purely technical because I figure that the people who have many more resources than I do and are much smarter and have billions of dollars all know the news and the fundamentals and the macro scene. And it's not my job to try and figure that out. It's my job to figure out how that supply demand imbalance is shifting in the markets at the time. So I very much try to stay in the present. I started off as a floor trader, so therefore you're always thinking about how am I trading that day? And then it's very much updating that one day at a time. So we get new information each day, and then we take that and trade the next day. Now, that doesn't necessarily mean that you have to be a day trader per se. But even if you're stalking a market, perhaps for a longer swing up or down, you're still processing the feedback that you're getting from the market day by day. Is there a slow dry up in the volume? Is there a contraction in range? Are we starting to see some little short-term cracks in the opposite direction, or conversely, green shoots in the other direction? So I try to monitor quite a number of markets just because when I started, I was on the options floor. And so we were always looking at, maybe 50 stocks each day at a time. I don't trade stocks anymore, but I could if I wanted to. So I stick pretty much to the domestic futures markets where there's the best liquidity. Liquidity is a huge issue for me. I don't like trading in markets that have less liquid conditions. I want to be able to get out when I get out. And so then my trading program really has not varied in 45 years. I've been doing this for 45 years now. And the first 10 years, I would say, was pretty much option arbitrage. So when you are engaged in some type of arbitrage activity, you are not necessarily playing for a directional basis. right? Okay. So therefore, when I started moving off the floor and trading more in the futures, which were dictating a directional basis, I tried to do it within the framework of a statistical framework. And therefore, if I had models, I could look at that in the same light that I would an arbitrage opportunity. See, so is there a signal? Is there an open door? Is there a convergence of some type of edge that we can manifest? And then another big part of the game is your execution skills. That includes how are you initiating your trade, as well of course, how are you managing that trade? And there's lots of different ways that you can initiate, exit, trail, etc. And so that really comes down to a matter of style. What is going to work for you? And that's where the importance of having a journal such as yours would also excel in pointing out which of these entries and which of these management tools are really doing justice for your strategies. So in that context, I am never one to average in. I don't believe in average in. And even if you have a style that dictates that you can add, I pretty much don't add. If I'm campaign trading, meaning I have a longer term technical bias, I might have a core position on, but then I will also trade shorter duration in the direction of that bias. So effectively, you are lowering your basis. And it sounds complicated, but it is not. It's just a matter of your organizational skills. And so because I have the ability to do a lot of different styles and programs, I can't do nearly as much as I used to when I had my hedge fund. And then I had 2 full-time assistants helping me organize and monitor and track and execute and so forth and so forth. So now I have dialed things back a lot. I've retired a number of years ago, even though I still trade every day. And I'm sort of back to just doing a few things that I feel comfortable with. And then the last thing that I will say, and this should be a ray of hope for everybody, is that you cannot put a price on experience. So you asked me what my edge is. And I would say that a huge edge comes out of number of years in the markets, because I know that how little I know. I know that just because I haven't seen it doesn't mean that it's not going to happen. And I know that there is also a huge amount of gold buried in the aberrations. And so in this environment that we are in the past number of years, where you have such fast, delivery of information and transactions and speed and a lot of money moving around in these markets, and they have become noisier and noisier. And so people really need to understand the type of environment that's going to favor their type of trading style and not get caught up in that noise. And so I feel like I have a good edge at recognizing not only when there is that noise level, which comes in consolidation and lighter volumes and so forth, and I can see when a market's starting to do that, but also I have a big edge in understanding myself when perhaps I might become more susceptible to that. And even though I have models that I trade around, you can still get caught up in noise and wanting to, perhaps jump the gun just a little bit, even though you might have a technical setup. And so all of these things, it's a conglomerate of things. And I wish it were so easy for people to say, oh, do your back testing, see where, the edge, the quote, quantitative edge is. But you have to understand that you've got a million algos and billions of dollars and supercomputers grinding this stuff out all day long. I have some colleagues and they run AI models, in the options markets, and they are retraining every single hour and every single minute, just constantly. This is going on out there. It's not going to impact you as a trader. And if anything, you should be grateful for that extra provided liquidity. But my biggest point is being able to recognize that opening where perhaps there is, that edge. It's not easy. And so it really does take concentration. And I feel like that's a huge edge that I have: concentration, eliminating distractions. And that's a huge edge. People have forgotten how to concentrate, They really they get caught up in listening to the news or the TV or social media. And I think that my ability to rely only on myself and put blinders on to all the outside news and tariffs and this and that, because it's always going to be there. In my experience, 45 years, it's like the news cycle. Every 3 days, it's going to be something new. It's going to be something new. It's going to be QE. It's going to be COVID. It's going to be, on and on and on and on. It's not just tariffs or inflation or egg prices or whatever. It's always rotating around. And then my last comment that I will say, and I understand that I gave quite a lot right off the bat, but these are things that for me are truisms. These are principles that I've seen decade after decade after decade. Okay. News does not drive markets to different valuations. All right. News is not going to drive Bitcoin to a new level. News is not going to drive, the currencies. News is not going to drive an individual stock, other than that's a slightly different case because perhaps the news of a good, better than expected earnings or something like that. But the number one driver for the markets is always coming down to two things: the liquidity conditions, how much cash is on the sideline, do we have an accommodative monetary policy, is that in the US or is it on a global basis? And then the second thing is how many people are already in that market, right? So right now we've got all-time historic record participation in the American stock market by retail participants. And so at some point you have to say, even if the news was superlative, who is left to buy? So that's why the news itself isn't always a good driver. It's more the market's reaction to the news, and then really understanding these monetary conditions, by which there's all kinds of measurements. So that can be very overwhelming. And it's not, I think if you're a retail trader, it's not your job to analyze that. It's just your job to understand that this is where the real driver is, and just ignore all that other nonsense out there and don't try and do the scenario building. Concentrate on the short-term technicals because we have an edge. We're not trying to move $2 billion. We have a huge edge just trading smaller size that we can get in and get out, in a split hair. And so you have to take hope with that. And again, be patient for your spots and try to stay technical.
That was a perfect answer. Thank you so much. What surprised me when you said your approach has not changed that much compared to 40 or 45 years ago. Do you mean on a higher level or even on the execution level? But the markets have, I guess, changed dramatically from floor trading to electronic trading these days. How has your...
Well, absolutely, sure, of course. And we've gone through many changes, I mean, for years, even when I left the trading floor, We placed our orders over the phone. I had a direct phone to the pit. I knew the brokers down there. I would tell them what I wanted. I need to buy 300, XYZ, do it over a 10-minute period, work the order, and now you can do all that with algorithms. You can say, even interactive brokers and half these platforms have stuff where if you are doing that kind of size, which I'm assuming most people are not, but when I had a fund, you can't just go in and bang, leave a big footprint. And, you have to be a little bit more tactful about how we initiate our orders. And that's why if you think that you can see in the futures markets, I'll just speak to the futures markets. If you think that you can see the book, you are 100% wrong, because 95% of it is hidden. You might think it says 50 bid and 50, offered and so forth, but there's icebergs. You can say, oh, okay, if 10 go, cancel the balance. There's just all, time slicing, just feed it out every couple seconds. So you really don't want to think about that type of, I don't know what they call it these days, the book and all that stuff. It's just, I don't even like trading off of a dome. Usually, I always had done my best with an assistant, and then I could say, hey, Kyle, buy XYZ, and to that, get the main idea right. Your trade should not be so skinny that it really depends on your exact fill. Okay, if you're worrying about your exact fill and you can't have some variance around that entry price, then that's not it's not a very strong trade. But with that said, if you are in the markets for shorter duration, meaning perhaps day trading, you want to make sure that if you have an entry and an exit, that at least one of them is done with some type of limit price or stop. You don't want to be doing market in, market out, because your VIG just becomes way too high. You are really giving up a lot in that case. So what I normally have been doing lately, and lately meaning the last 5 years, because I don't have my assistant anymore executing for me, is I will usually go market in, because I'm usually pretty good about tape reading right, at that moment that I want to get in. Or sometimes I just want something and I'm willing just to pay for it. But then I will always try to, when I feel it's time to get out, at least place an offer, offer limit, those types of things, or even pulling a stop up if I'm playing that type of game. Sometimes I just use a time of day entry or a time of day exit. So those are some of the subtle changes just with the execution side, but that's really a minor part of the game. Execution is what can take a $300 average trade and make it a $350 average net trade, across a 100 trades type of thing. Your execution skills can improve that, but it still comes down to getting the main idea right. And so I try to caution people, what is the trend for the day? That's really the most important variable. Is there a trend for the day in your particular time session? Because you've got Asia session, you've got Europe session, you've got US morning, and then we have US afternoon. And it's really rare that you have more than 3 sessions back to back. Usually it's 2 sessions back to back. So if you have Asia up and Europe low to high, invariably US morning session might trade high to low and then resume the trend. So think about your trend for the day in your particular session, and then we can extrapolate that and say, can we do the trend for the day on our basic 24-hour candlestick chart? Is it a low to high day, or is it a high to low day? And I think that goes a long ways towards simplifying the noise, because too many times. Think, I don't know for sure because I really don't talk to many people during the day, but I think that most people are looking at too short of a time frame, and you are not going to be able to execute gracefully or consistently if you're doing 2-minute charts and 5-minute charts and stuff like that. Very few people can. So of course you can get some nice little scalps of, on that, but big picture, you need to step out a bit more. So especially with the noise and the spread between the bid ask, and if you look at, I can see a lot of times, I've got very fast connectivity, and even if I do a market order, I'm like, that's not right where it was trading on the screen. I'm going to get filled 2 or 3 ticks away. So
So can I see your trading methodology as basically, or like a top-down approach where you look at the daily chart first, and then you're looking at the sessions, and then you are determining, okay, this session is very likely going to be a flat session, up session, down session, and then you're trading on the lower time frames in accordance with that bias or thesis.
So I divided up into sort of 3 profit centers. Okay, so the S&Ps are really the only market that I'll like to day trade, and by that I might just make 1 or 2 trades a day, if even. And then my profit center 2 is sort of all my patterns and modeling that I've done over the years, where it's in one day, and if it's a successful trade, I try to hold it 1 or 2 days. So in one day, out the next, or the day after that. And then there's my third profit center, which is kind of based on daily, weekly technicals. So I love the weeklies, but you have to understand now, once we are looking at a longer duration, your frequency of occurrence for those particular choice setups drops off dramatically. Okay, so we can't force a weekly bull flag or a weekly sell divergence, and it doesn't really matter what the market is. It seems like there's only maybe 2 to 3 strong weekly technical, new swing up or new swing down type of thing a year per market, and you might miss 1 or 2 of those. So that's sort of the third wheelhouse. So we have to kind of keep ourselves busy in the meantime. And with the in one day, sort of out the next 2 or 3 days, I am using basic bar charts. I like the daily candles. It's about the only time I'll look at a candlestick. It just is a nice big fat, bar where you're not looking at too many bars. And then I use momentum functions. So that stuff is all pretty much influenced by that tailored trading technique, kind of looking for a new swing up. Can I catch that first day low to high? And if I can capture that first day low to high, and then can I push that for another day or 2? And it sounds easy, but there's periods of noise. There's periods where you start to get the ranges contracting, a little bit of consolidation and rotation. And then more so than ever these days, we have these extreme alternations in states. So we've either get this extreme rotation, consolidation, narrowing of ranges, which can last, 1 week to 2 months. And then when there is going to be that opening for the markets, you'll get what market profile people will call one time framing, which is sort of the environment that we've been into, the downside here of making, at least in the US indices, consecutive lower highs and lower lows day after day after day. And that has become more pronounced every 5 years. It's more extreme because people aren't stupid, and all of this stuff is programmed into the algorithms, which are not smart, but they're just execution algorithms. And if you were, for example, to think of a large fund and they had a position of, X amount of shares in NVIDIA or whatever stock it is, It's going to take them at least 10 days to get out of that position. You can't just boom, exit, all your mass holdings that you've built up in NVIDIA, so you have multiple funds trying to reduce their size, reduce their exposure, and usually that will assert itself in the morning session. So if you have a strong trend intact, you will see it manifest itself in the morning. And, it just is this steady drive. I don't, until eventually you have some selling climax and, everybody's like bearish. And even then, if you are a student of Wyckoff, you will see you get that automatic reaction up and then that automatic retest down type of thing. So again, back to classic technical analysis, I think will serve you better than anything else. Chart formations, Wyckoff, understanding the markups and the distribution and all these good things. You really don't need a whole lot in your analysis of technical education. It's just really a matter of you applying yourself and studying day after day, not necessarily past examples, but what's going to happen tomorrow. Write out what you think is going to happen tomorrow, and then see how it plays out. And then you do that the next day, and then you do that the next day. And that's sort of what I've done for my entire trading career. And so we're all like human AI machines.
I find this fascinating because when we do those reviews for the Edgewonk users, we see, first of all, traders always think that they need to find the next hottest strategy and they're always looking for this secret edge that hasn't been out there. But from what you said, it can be about the classics, the things that have been time tested over decades and decades. So this should put a lot of people at peace that they don't have to always chase a new strategy, which is something that I find really, really helpful, I think, for a lot of traders.
Yeah, I hope people feel that way because it's a very gimmicky world out there. Everybody's looking to sell something or create something because, those who can't trade end up, being whatever. I'm not here to, make judgment on anybody because you can always learn something from somebody, but I mean, the basics will serve you for forever and ever and ever. And you really can't break it down more than the things that Larry Connors and I put in the Street Smarts book in the mid 1990s, It's either going to be a flag, which is a continuation pattern in an existing trend, or it's going to be that consolidation leading to a potential breakout formation, or that loss of momentum where there's a divergence. And I think somebody that has done the work and studied this day after day understands that what the indicators show you, because they're just a first derivative of price. There's no hidden magic in that. It doesn't matter if it's a stochastic or an RSI or an MACD. They're only highlighting what is there in the price action. And you'll find that over time, the top pros, you can strip away all the indicators. You can strip away the moving averages and the, oscillators and all that stuff. And you'll see it in the charts. So, and there's just like really basic little simple rules. Okay, you're in an uptrend making new highs. You have 3 bars low to high, and then you have 1 high to low bar, and the next day is going to be a buying day, So unless you have some wonky divergence. But I think that, everybody finds their own way. And I think that part of that exploration of different strategies, it's part of the process. I did that too. We used to have something in the late, was it around 1990? It was called Club 3000. Maybe somebody will remember that because we didn't have the internet in those days. And it was a monthly newsletter putting out different systems and, looking at stuff that people could play with. A very popular system at that time was one called aberration. okay, which took an initial large standard deviation move and then used that to initiate an entry. And there was a trade management function there. And I think it had a win rate like, I don't know, 26%, something that most people wouldn't find acceptable. But that dang system made money year after year after year after year until finally, you know, all the top pros bought it and it kind of got exploited and arbed out a little bit. But in that process of studying these different systems, you start to understand that there's a unique event very often that is powerful information, just like a volume spike, you know, or a big volume bar on a daily stock chart followed, you know, that comes with a gap, you know, the market's telling you that there's something unusual going on. And so that we all learn from still going through the process of looking at these things. We just don't want to delude ourselves that the grass is greener on the other side of the fence.
So you really have to pay attention when you're looking at your charts, which brings us back to this distraction issue that also social media and infinite scrolling is bringing. So I think people always expect those textbook patterns to show up, but they don't study the nuances, which probably will help them trade even those classic old patterns in a more profitable way, instead of always expecting the textbooks to show up on their charts.
You know, one thing that I still do every year, I don't know why, it makes me feel productive, even though it doesn't, but I'll take something that I want to look at, and I have several strategies that I do this with at the end of the year, end of my end of year review. And I'll print off the whole year's worth of data for 20 different markets. And then I go back with my yellow highlighter and I circle the, you know, working backwards. Okay, you know, here were these opportunities and which ones led to something and which ones didn't. And so you're always looking at that and programming your brain to totally, you know, recognize immediately when you see these things, and then you don't have to spend too much time. Is it, isn't it? Well, maybe I need to look at this, da 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 da, you know, so you end up with a much stronger feeling of certainty, you know, like, yeah, this is, you know, I know this pattern, you know, this is a 95% trade. It might only happen one day a month, you know. I know my best patterns might happen 2 days per month per market, you know, but if I have a stable of 25 markets, and now I've got, you know, 50 potential trades with this strategy just because, and I know that I might capture maybe a third of them, and maybe that will make this core amount, and that's just one strategy. But of course, that's assuming that I'm trading full time and don't have a life. Because it does take a lot of preparation, a lot of study. And I think that most people, you know, we come to think that we're smart and we just want to get it so much faster. You know, we want to read it and then, oh, make it ours. But that process of taking a strategy that you've taught or you see or you read about, and then making it your own, adding your own little twist or your own little filter, and then seeing, does that work on the bonds? Does that work on crypto? Does that work? It's a long time intensive process. And you have to make that the most important thing in your life. And sadly, you know, that supersedes even relationships at times. You know, I know almost every trader I know has gone through a divorce, probably because they were obsessed in front of the screens for far too long and ignored their spouse and so forth. But it's a truism. So, and if you don't have that luxury of just unlimited time to go down a rabbit hole for one weekend, conversely, the markets are just the greatest hobby in the world. You may not have the time at this point in your life to necessarily try to do it full time and develop your strategy and approach full time, even if you have a family or even if you have a main primary job. It's the best hobby in the whole world to study technical analysis and continue to network with colleagues that have a similar interest as you do. You know, that's really the thing that the trading has brought to my life. I know when I trade, I'm totally solitary. I don't want to know what anybody else is doing, and I don't want anybody to know what I'm doing. I'm a very solitary person there. But on the other hand, I probably would not make it in this business if I didn't have other colleagues on Skype, which is going to disappear, or, you know, people I've developed relationships with over the years and be like, oh God, I can't believe I just did this today. Oh, I totally whiffed. Da da da. Why, you know, I got out, but I had to pie it back higher or something. And then the other person's like, oh, well, I did 10 times worse. And you're like, gosh, I feel so much better now, you know. Or else you have a, you know, a nice evil sense of humor, because humor carries us a long ways too, you know, to help release the tension and
Right.
just it builds
Yeah.
up.
That's something we see quite a lot actually in the journals that we review, that sometimes it seems people are hard on themselves, but I think it's also just sometimes you need to let it out, to get it out of your system. So I think that makes a lot of sense. One thing I want to ask you, how important do you think is specializing in strategies? We did 2 or 3 reviews recently where we pulled up a journal and a trader had like 15, the other 20 different setups and strategies that we're trading. And seems like there was a lot of noise and inconsistencies in the approach. How do you see that?
Oh my God, I think that is way, way, way too many strategies. I think you really just need 1 or 2 good strategies, but then you're going to have to do that across 20 different markets, okay? Or specialize in one market. You can do that equally well. You know, I know a lot of people that are great traders and they just specialize in doing the E-minis. That's their game. I mean, I know myself, I don't like trading the NASDAQ. I'm not a great NASDAQ trader. I used to be good on the Russell, and then that got sort of wonky. But I love trading the S&Ps because there's a wealth of information there, you know, between the stocks and the leadership and the breadth and the ticks and so forth. So I think you can do very well just watching that. I have a difficult time now doing my day trading S&P program, which again might just be making 1 or 2 trades, but it's a lot of monitoring and doing my other programs, you know, the sort of in one day, out the next. And I would say with that style of trading, which has been influenced by several things over the years. I mentioned Taylor, I mentioned my momentum functions, volatility breakout systems. I really studied those a lot so I could understand the importance of staying with the trade when you got that range expansion, okay? And then how does the market react the next day? Well, I know that there's 80% chance that that the market will trade above that high, you know, in the next session, the next start of a new session, but it might only have a 50% chance of closing above that high. So you see, we're all modeling each of these little parts. And so, you know, I can boil all that stuff down to maybe 3 or 4 main setups that I will look for. And it just is going to sound really simple. Is it a buy day, you know, or is it a sell short day? And if I catch one of those rights, I know how to manage it. And I also know what if it's a buy day, but I'm too soon, you exit, just as Taylor would say, and you look to play for position. You'll get a better entry perhaps the next day. So, yeah.
One
But I don't know,
thing
20 strategies, that's insane. Yeah.
One thing I'm wondering about is because you said, I mean, your workload must still be quite intense, even not as much as probably when you're working in the hedge fund, but still very much so. And you have been trading
My
for
workout?
your workload.
Oh, my workload. Oh,
Yes. You have
nah, my
been
workload is nah. I've throttled everything way back. I try to play tennis, 4 times a week. I have my horses. I go out and I ride every day. I can't do the things that I used to do in the gym. One time I was very much into working with the weights in the gym, but then I blew out all my shoulders and your joints and arthritis and all these lovely things as we grow older. So tempered that back. Now I'm walking the dogs. So yeah, just trying to stay healthy and balanced. And I think for me right now, it's more uh, low stress, keeping my cortisol levels in check. So I'll never trade as big as I did once. I'll never trade as intense as I did once. That was truly a different period in my life. And I'm very grateful that I did that and I had the support to do that, because you can't do that by yourself. You need a support system around you to do that. People have to understand that, not just supporting spouse, but I had a business manager who handled all the bills. I had lots of extra support functions. I had a full-time tech guy who could handle all the the internet's not working, the computer's not working, make it work, that kind of stuff. It's stressful, all these things are variables. So but that's what allowed me to accomplish the things that I did. And so now I'm enjoying the game, but I'm enjoying the game on a much lower paced, less stressful level. So it's just the fun of playing it, I just like to play it.
I listened to your podcast with Stephen Goldstein from Alpha Minds. And one thing that really caught my attention and I felt like really inspired by when you talked about creating your own game, that we or as traders you have the power and the freedom to actually create your own game, which is not something that I think a lot of people realize when they feel like they need to copy someone else and go that way.
In the interviews with Kovner and Richard Dennis, when they were doing their turtle selection, and could have, they had hundreds and hundreds of people from whom to choose from, they chose those who had an aptitude for game theory. So game theory, now we're in a realm of more understanding the probabilities. It's a much less emotional world. People who excel at playing poker and blackjack, and that's why there were some of the poker and blackjack players in the original group of the Turtles and so forth. They all excelled at game theory. So that was one of the traits that they really looked for. And it's one of the things that appeals to me. I love math. I love numbers. I love musical notes. I like relationships, arbitrage. I suck at history. I suck at literature. I suck at writing. My vocabulary is terrible. It's all 4-letter words. So that's how my mind works. I like boundaries and definition, and I'm going to create it to suit my style and understand when I can transgress across those boundaries. So, I mean, think about tennis. I love tennis. You have a court, you have the lines, and now pickleball is the rage in the United States. So, but there's rules and so forth. But within that context, we can play all kinds of little tricks and, little drop shots and spins and so forth, but it's a closed universe. So understanding system dynamics dictate that dealing with a closed universe where you have finite variables is a luxury. Okay, the markets are not a closed system. We have new inputs coming in all the time. And that is one of the, I think, the challenging things for people to understand. They want to think that they can study, oh, this happened in the past, it happened this time, and this time, and this time. All I have to do is look for it this time. But it doesn't work that way, because now there's a tsunami, or now there's a COVID, or now there's, some other variable that's introduced into the system. It's not a closed system. And so that's where the importance of the money management is. We can define our playing board as if it's a closed system. All right. So that's what I like to do. I like to treat it as if it's a closed system, but that's why also you need to have that importance of a worst case scenario, shut things down. And that's to deal with perhaps an outside variable that your system or your strategies or your playing board has not yet seen. And I'll give you a really good example of that. Perry Kaufman is just a dear, dear friend. I respect his work and research like probably more than anybody else's. He was original rocket scientist, if you want to read up on Perry, and he's got, a great book of all his trading systems and so forth. So Perry actually was literally a rocket scientist. So his mind also thinks this way, trying to eliminate the discretion and reduce it down to some types of systems, usually with a trend following component in it. But he told me that for his portfolio, he had just implemented a 10% stop loss on the entire portfolio, meaning on a systematic basis. And that happened right at that first year that COVID hit. And he says that saved his ass, because it hit that 10% threshold. Okay, this is my line in the sand, close down everything. And then how much lower the market went. We went down 40%, which was, a lot of heat to take if you were just going to buy and hold forever. So I always look to Perry, as sort of like my idol and my mentor, just in terms of some of the things he's implemented with his systems. And maybe, other people can do that too. Oh, I like this little piece of what this person added to their process. Okay. And, that's another way of thinking about your game or your game board. It's really your processes that you have created for yourself. My process of doing my homework at night, my process of once I sit down at the desk in the morning, how I am going to operate, my process of once I am in a trade, how am I going to, manage that? Maybe I'm not. Maybe I'm just in the trade and I'm just going to get ready to bang it out if it's a little scalp, and usually in those cases, I don't want to be trying to put in stops and this and that and stuff, because I'm prone to making execution errors. So I'll just be like, okay, I'm in, and okay, thank you. Okay, I'm going to leave for the day. And I don't want to oversimplify it, but I'm just saying that, they will say, oh, you need to have a stop in every time. And a lot of times pros, we don't have that same type of stop, but we know how to manage it if it's not working out, which is start getting out before your stop gets hit. So all of these processes, at the end of the day, what is your process for recharging your batteries? That's really important, because if you don't take time out to recharge your batteries and clear your head and take a break, invariably, what everybody does is they start doing dumb things until their account starts to draw down, and then they're like, F it, I gotta walk away. But it doesn't have to be that way. You don't have to hit that point of self-disgust in your bad habits before taking a break. But yet that's what happens to everybody. So, and that's how I learned the hard way a zillion times. I'm no different than anybody else.
Talking
No, go ahead.
about habits and habit building and systems, etc. I'm really curious about your worst, deepest, or longest drawdown of your trading career. Can you talk a little bit about that and how you made it out of that?
Well, that's a great question because, how are we categorizing our biggest loss? And I will tell you one thing, if you're newer on your trading career, been trading for 20 years, if you've been trading for 30 years, the biggest loss is always yet to come, primarily because you're doing larger and larger size. So in a perfect world, with this game, and it's one of the very few professions that allows us to do that, is the scalability of it. If you find something and you can do it well and consistently, the real money is made by doing it on larger size, not necessarily longer holding times, not necessarily swinging for the fences, but okay. Tom Baldwin, who was probably the greatest bond trader in the pits, and I think there's a book that he wrote 20, 25 years ago, used to say, and he made a lot of money for that time. I just do the same thing as everybody else. I'm just doing it on much bigger size. So he would take down a bond trade. His holding time might just be 5 minutes or 10 minutes, but he would do it on 2,000 contracts, not 20 contracts. So, but that takes a bit of confidence and building up to that, so that you feel like you have all of that in control. My biggest loss was a case where it was a dollar loss, and this is when I had my fund, so it wasn't my personal loss. And I'll tell you a bad personal loss. And I mentioned this in my book, and it was, I don't remember how much money I had under management, but I thought that the market was looking, rolling over. We had started trading from the short side. It was a Friday, in the middle of the day, and I put on a short S&P position, and I think it was short Russells, and I think I was short 600 S&Ps and 600 Russell, and I don't even remember if they were the bigs or what they were. It was just, and then that was when the Fed came out after the close on a Friday afternoon and said that they were bailing out Fannie Mae and Freddie Mac. So the United States, our financial institutions were very wobbly and shaky. And this is when we were having Lehman go under, and 2008, it was just like right at that period. And I put on probably the biggest short that I've ever put on in my life on a Friday afternoon. And then, as it turns out, I had a bad tooth that the doctor had to pull out. And so I was in the dentist chair, and it was after the close. And Judd, who was my assistant, called me up, and he's like, well, bad news here. The spies are trading up God knows how many handles. I'm like, oh, great. So at that point, there's nothing you can do. The markets are closed. You're just like, oh, this is, I got to wait till Sunday night opening. At which point, I think the S&Ps opened up 40 handles, which nowadays is nothing, but 15 years ago was a lot. And it was about a $4 million loss. And I'd never had that kind of a loss just in like an overnight type of an event. So it was an event risk type of thing. So there's a difference there. It's not like I didn't have money management or know what I was doing, but it was event risk, which is always a possibility, if you have a fund or larger size. Now, the $4 million loss really was at that point, I think it was about a 4% drawdown for my fund. Okay, so you can look at the percent drawdown, seems like nothing. All right. The dollar amount felt, it was like a big dollar amount. And but in the context of things, I knew it was manageable because I knew our unit size and the size that I was trading. So Sunday night, what I did, we gapped up higher, and I immediately closed out half of the position because I can't trade well when I have this big old monkey, clawing all over me. So I've learned that if you're in a loss, just get out of it. You can always put the trade right back on, but it's amazing. Once you take that off, the head clears, the cobwebs go, and you're free. You're free to trade and start getting back into it. So that's what I did. I took half off. Then I felt more comfortable trading more aggressively. We started trading again, and I think at the end of the month I was up 2%. But that was you just break it down into bite-sized pieces, reduce it down to the size, the sleeping size, as they say, reduce it down to where it's manageable trading, get back in there, make a little bit back every day. I figured if I made a little bit back every day and followed my program, it wouldn't take long. So that was one case that sounded really that I hadn't experienced before, having an overnight gap that cost me $4 million. And then I will say that when I first left the trading floor, and I was trading from, they say upstairs, but I had this home office that I had set up for myself, and this was back in 1988, 87. And, cost me $1,000 to run the phone line to my frickin' little townhouse, cost me another $1,000 to get this stupid data feed, CRT terminals or whatever the heck they were at the time. I mean, people have no idea how great they have it now. And there's something that we look at that's called variance. Okay, so variance is something that's a term that's very well known to poker players. And variance, just think of it as the standard deviation in your equity curve or your bottom line. And so my experience is that as I progressed from being a lowly peon floor trader to making more money and having my own capital to trade and blah, 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 my variance was very high when I was young. I didn't have responsibilities. Initially, I didn't have a kid. I didn't have any obligations. I didn't care if I drove an old beater car. It wasn't important to me. But the swings in my account were pretty, wild, usually in terms of giving back profits. And so this particular year, that's exactly what happened, is that I had built up, I think I was up like maybe $500,000 or $600,000. This is back in 1986. And I thought, this is fine. I'll take some time off. I want to go work for a horse trainer and an apprenticeship and, that kind of stuff. And then this is when the crash of 87 was happening. And so my husband called me and told me, come back and da, 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 da. And I'm like, a little bit overzealous, they say you're getting in too early there. Well, that's what I did that day on that Black Monday, and look at these S&Ps, they're trading at a 20%, a 20-point discount. Well, nowadays I understand there's a freaking reason why they're at a 20-point discount. I'm not going to be the one to arb that, right? But, you're like, look, they're cheap. It's on sale, So that 20-point discount cost me $500,000 by the end of the day, something like that. I think I was up $800,000, and I gave back like $500,000. Like by the end of the day, I'm like long. I would think it was only long 12 S&P contracts. These were bigs back in those days, but it was a small handle. And I was just like, how did I just undo my whole year in one day? Whoa, what happened there, But I was averaging down, and so I got really, really, really lucky, because that next morning they gapped up, and miraculously I was able to get out. But you don't want to press your luck on something like that more than once. So those are the two most extreme things, and I got lucky in terms of getting out of those pretty quickly. I have to say I haven't ever really had a prolonged drawdown period, probably because as I have gotten wiser and older in my trading career and with my fund, I just trade on much lower leverage. I'm not swinging for the fences. I don't have anything to prove. I know the turtle wins the race. I know it's a game of positioning, 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 and then you get lucky. So if you really understand statistics, this is a game of fat tails, and you want to be able to position yourself to capture a fat tail, which of course, nobody can predict a fat tail, but we can also know where they come from, the conditions that precede them, and then recognize one right as it's starting to unfold. Okay, so that's also back to that experience level of understanding that fat tail. So I'll be on much lower leverage these days, but it's always conditioning, just as if you're counting cards. It's really no different. Poker's a game of money management. That's all it is. And if you're betting too big, you've lost all the concepts of capital preservation. So these are just very basic lessons that you can study from poker. You can study from racetrack betting, turf betting. There's some really good books there. You see all of these things are statistics and, capital preservation, money management, and playing the game until.
Fantastic. I read this book, The Gambling Wizards, and there were like horse bettors, poker players, and there was also a trader inside. And it's really fascinating that all talked about variance and money management. And it wasn't so much about the actual discipline, but at the core, it was really, really similar on how they approached it. So that's
Wait, what was the name of the book?
Gambling Wizards, I think.
Yeah, that was a great one.
Oh, cool.
It's really, really fascinating. Yeah.
I love to read that stuff. I really do. Did you, when you were reading that book, did you see commonalities between personality types, or was it sort of all sorts of different personalities, but yet certain understanding of the statistics behind it? What did you see?
I think the people featured that were really, really different, but at the core, their understanding for the probabilistic nature of the games that they were playing. And I think also the passion for the field that they were in was really what stood out there.
Well, that's a really good point, that passion thing, because I think that if you have that passion, it makes it a really fun arena. It's not always fun, in terms of like when we're going through a challenging period, but it's a fun subject that you love to study. And that's why, I'll get this book and read it just because it's, it's my hobby reading all this stuff. And yeah,
It's a fun
cool.
read. It's really cool. Yeah.
People that are passionate about something, they're always, if it's golf or tennis or a sport or music, you are staying fairly immersed in it. And I just saw this Netflix documentary 2 nights ago that came out, and it was called The Only Girl in the Orchestra. And it was about the first female full-time member of the New York Philharmonic Orchestra, the New York Symphony. And she had just retired after being a full-time member for 55 years, and she was 87 when this was shot, and it still showed her. Now, she was a double bass, the big bass, and she was lugging it down the street. She didn't even have it on a wheel. I'm like, damn, no wonder that woman looks so dang fit, and is mentally so sharp. And it showed her she's still teaching her students. She's still, and this was her whole world, and it was just a wonderful, rich, marvelous world of people that shared that same passion, and she could mentor and teach them. And just, you could just see her, just with the music and stuff. It was really an inspirational show, only 35 minutes long, but just inspirational about her level of passion that she had. And probably the same thing with the markets. But you see these people, but Warren Buffett, how old is Warren Buffett? Like 97 or something? Thinking in his bathtub, or, Richard Simmons, he's no spring chicken, with Renaissance medallion. I mean, it's like people are doing it. They don't have to. They've got billions of dollars, but they like it.
They
They're
like the game,
passionate
yeah.
about it.
In for the game, yeah, totally. So Linda, I want to be mindful of your time. It was really a fun conversation. Time flew. You've shared a lot of nuggets, but if there's one thing because we have a lot of new aspiring traders, one thing of advice that you would like to pass on that stands out?
Well, I will say this. Everybody's hard on themselves, far too hard on themselves. And just understand that whatever challenges that you're feeling, we all have felt those challenges. We've all made the same mistakes. I've probably made the same mistakes as everybody, and I've probably made them 100 times. I even blew out once in the very beginning. So you have to be treat yourself gently, because when we are under stress, we tense up, we get negative emotions, you get cortisol, and then you don't do your best thinking or your best performance. So understand that it does take a minimum of 3 years. Despite how much reading and studying you've done, it's going to take a minimum of 3 years for you to figure out what works best for you. You might find a strategy, try trading that for 3 months. Say, nah, I don't like that pressure of doing the day trading. Maybe I want to, do some overnight stuff, or maybe I want to do the options. And so it's a lot of trial and error. I've never seen anybody be able to arrive at that point that you could support yourself making a living doing this year after year after just 3 years. I've not seen anybody do that after 5 years. You might get lucky because one particular environment favors your game, because we had some crazy momentum environments, in the last 5 years. But so give yourself time. If you were becoming a medical student, or you wanted to become a neurosurgeon, how long is that going to take you to study? It's going to take you 10 years minimum and internships. And guess what? If you did that same amount of time and devotion and study with trading, you could be in a position where you make more money than a neurosurgeon. But, you have to really be committed. So it's okay, to step back. I know people that have stepped back for a little bit, breathe, and then come back and, like take another go at it. But just do your own thinking. That's really important. You have to learn to see and do things for yourself and find what works for you. And only you can figure that out. So just, be good to yourself. It seems like it's an exciting, glamorous profession, but it's just a grind like any other profession. We have slow periods and dull periods, and I have a lot of days where I have no idea what's going on. So be good to yourself.
Thank you.
I love
Wonderful
that.
advice.
Thank you. Yes.
If people want to connect with you, I know you are active on Twitter. Where else can people connect with you if that's something that you...
Twitter's a great way. I have an email address. I really need to make a new website, so it's just been something I haven't gotten around with. I think there might even be a way that says contact me on there. Don't, because I have no idea if it'll even get to me. But probably the best way is just Twitter and the notification sections. I go there like at noontime. I don't have Twitter open, just so you guys understand. I don't have it open. I might feel inspired to post something at night. I might feel inspired to post something in the morning. I just don't want to get distracted looking at cat videos. See, I got a good sense of humor, right? But if you put in the notification session, hey, where can I contact you? Or I had a question on this. At lunchtime, almost always I'll go through and, respond back to people. So
Great. Yeah. Everything will be linked in the show notes underneath underneath the podcast. Again, thank you so much. It was a pleasure and honor. And thank you so much for taking the time today talking to us.
You're
Yes.
welcome. And good luck with your your Edgewonk. I mean, I'm gonna go onto your YouTube video now and see what that looks like. Maybe I can cop a free trial to play around with it.
For
I
sure.
think that's doable, yes. Thank you.
All righty.